Welcome back, investors. Jake here. In this video, we're going to be talking about my YouTube mentor, Graham Stephan, and this is a true story. 2.5 years ago, Graham posted a video, how to get your first 1,000 subscribers on YouTube. It inspired me to sign up for his YouTube Creator Academy course. Here we are 2 years later, I have over 70,000 subscribers and I'm making 6 figures from YouTube, so I definitely owe Graham a lot. And the video we're going to be talking about and reacting to was posted last week, and it's titled Why I Sold My Stocks. Graham is the largest finance YouTuber with 3.5 million subscribers. This video has over 300,000 views, and this truly is an incredible video because Graham, who's worth tens of millions of dollars, is revealing significant losses in his brokerage accounts. And I feel like a lot of finance YouTubers are not being transparent with their audience. They're pumping and hyping up these tremendous growth stocks, IPOs or SPACs, and while the stock price is going up, they're posting videos daily or weekly. However, as soon as the share price of the company starts going down, they don't talk about that stock anymore. They don't reveal how much they bought, when they sold, and how much they lost. So I'm appreciative that Graham posted this video talking about his losses. However, in the video, he didn't really explain why he thought he lost money on these companies. He basically just said, I bought it thinking it would go up, it ended up going down, so I sold it. So in this video, let's talk about these 6 positions and go over potentially why Graham lost money. And the reason why Graham said he was selling today was because of tax loss harvesting. He explains what that is in the video. I have my own dedicated video to that topic I will link down below. But basically, capital losses offset capital gains. So if you sell certain positions for a loss, you can then sell certain positions for a gain and not owe any taxes this year. However, still not a great strategy to say, to avoid paying $20 in taxes, I will lose $100. Tax loss harvesting is kind of a consolation prize for bad investing. So ideally, you want all your positions to be making money year to year, but if you have to sell for a loss, might as well sell something else for a gain and avoid taxes this year. And in the video, Graham flashes his personal account balance and it shows 8.4 million. This is a little confusing because in the video he says my $7 million stock portfolio. So what I think is happening here is he's using Charles Schwab, and I know it's Charles Schwab because I also use Charles Schwab, and his personal value is showing 8.4 million because he also has a Charles Schwab checking account. He probably has between $1 and $2 million, maybe in an IRA or a checking account. But his stock portfolio with Schwab is about $7 million. Now, Graham has done a lot of referrals with Robinhood, Webull, and Public. I don't know what his stock positions are in those other brokerage accounts. He only showed us his personal value in his Schwab account. And you'll notice with Schwab's interface that under the personal value amount, it gives this green number, and that shows how much your account is up year to date or over 1 year. In this account, I started with $25,000. I haven't added any money. Year to date, I'm up 104%. And you can make out what this number is below Graham's personal value. And it shows that he's up $3.9 million or about 87%. Now, that isn't his stock portfolio performance because this includes deposits. So over the last year, I'm assuming this is year to date, Graham has increased this account by 3.9 million from his trading and his deposits. In the video, Graham indicates that a majority of his stock portfolio is just in index funds, Schwab's Total Stock Market Index Fund, SWTSX, Schwab's International Fund, SWISX, and Schwab's S&P 500 Fund, SWPPX. And the rest of his account is in individual stock plays. And the 6 that he sold for a loss last week are ARKK Genomic Revolution ETF, C3AI Incorporated, Canopy Growth Corp, Corsair Gaming, Peloton, and Robinhood. Let's go over each one of these positions, and I'll give you my thoughts on why Graham lost money on these 6 stocks and ETFs. The first one is ARK's Genomic Revolution ETF, and in the video, Graham shows how much the stock or ETF is down this year, but then he also shows a screenshot from his Schwab mobile accounts. And this is pretty cool because with this information, you can actually tell a lot from Graham's purchasing and his positions. So for ARK's ETF, he bought 300 shares. The current value of those shares is $19,290, and he's down $12,000 or about 39%. So how much did Graham originally put in and what was his cost basis? We can calculate all this. 12,793 is 39.88% of what dollar amount? And doing the math backwards, we can figure out that Graham originally put in $32,080 buying these 300 shares, 32,000 divided by 300, and we can get Graham's cost basis for this position. So if we know that he put $32,000 into ARK's ETF and his overall Schwab account is worth $8.4 million, then this ARK ETF was only a position of 0.37% of his account. Very small indeed. Now, Graham is worth 10 times as much money as I am, so for him to put $32,000, yes, that's a lot of dollars, but to him, this is the equivalent of me YOLOing $320 on a chance play that this ends up panning out. So what's really interesting about this $32,000 position that Graham took in ARK's Genomic Revolution ETF is I think a year ago, Graham only had about $3.2 million in this account. So what he's been doing, or what he did a year ago, was he took a 1% position. So if he had $3.2 million in his Schwab account a year ago, he bought $32,000 worth of ARK's Genomic Revolution ETF. Now this is down 30% year to date. Why did Graham lose money on this position? I can't really speak about this ETF. That needs to be basically its own dedicated video because an ETF is made up of dozens of stocks. Ideally, diversification should protect you. If one company performs terribly, hopefully the rest of the companies can still give you a decent average return. But SPY, the S&P 500, is up 24% so far this year, and this ETF is down 30%. So Cathie Wood underperformed the market average by 54%. So let's get to the individual stock positions that Graham sold out of, and the first one is C3AI Incorporated. This recently had an IPO, and it looks like Graham put in $47,000. My guess is that he originally put in $32,000 about a year ago, and then he tried adding another $15,000 as it started going down. However, it went down and it never went back up. Why did Graham lose money on this position, down 62%? And this company doesn't have earnings. Lots of IPOs and SPACs, as they get out, they don't have earnings. So the only way you can evaluate the fundamentals of this company is by price to sales. And the price to sales today for this company is 16, meaning that when Graham bought in, the price to sales for this company easily had to have been 70, 80, 90. And in general, guys, for companies that don't have any earnings, if their price to sales ratio is higher than 5, I personally am not going to touch that stock. If it's higher than 5, 6, 7, or 8, this stock is going to tumble. It's going to have a downturn. Additionally, with IPOs and SPACs, the reason why they perform so terribly over a 1 or 2 year period is all the insiders are selling out. Insider transactions, insider ownership has decreased by 53% over the last year. The reason why is because all the original investors who did this Series A, Series B funding, they're just trying to cash out. As soon as a stock goes IPO, everybody who originally invested in the company when it was still private, they're the ones cashing out at the expense of people buying it at the IPO price. The joke on Wall Street is IPO stands for it's probably overvalued. A lot of these investors sometimes have lockup agreements, but they expire. They expire after 3, 6, 9, or 12 months. And as soon as they can cash out, they will do it. As soon as the people who work at the company can cash out, they will do it because they know the stock is overvalued. Additionally, this company has been diluting its shareholders like crazy. When it IPO'd, there were 73 million shares in existence. They've increased that to 103 million. So 30% of this stock's decline, if all other things are held constant, can be entirely explained by just share dilution. And IPOs and SPACs are terrible about this. Next company that Graham sold out of is Canopy Growth Corp. He took a $33,000 position, only 0.39% of his account. He lost $14,000. So why did he lose money on Canopy Growth? Well, this is a terribly run company. I'm just being honest with you guys. They have financial statements going back almost 10 years to 2013. This company, in the last 8 or 9 years, has never made a profit. They lost thousands of dollars, they then kept growing, they lost millions of dollars, they then kept growing, and now they're losing billions of dollars every year because they cannot make a profit. So how does a company that can't make a profit stay in business? And they do that by diluting their shareholders, diluting you, the person who might buy their stock. In 2014, there were only 39 million shares in existence. Let's see here, 7 years later, there's now 393 million shares in existence. So the value of the stock that you bought in 2014, all other things held constant, went down by over 90% because of share dilution. This company doesn't care about their investors. You should not be buying this stock. It's basically a scam, guys. So if it doesn't have earnings, it doesn't have a P/E ratio. So what is its price to sales ratio when Graham bought in? And he bought in when the price to sales ratio was 28. Once again, anything above 5, and I personally would not touch this stock. So to be buying in when the price to sales was 28, that explains why Graham lost money on this position. Next stock is Corsair Gaming, and year to date, this stock is down 54%. Graham put in 61,000, so what I'm guessing he did is a year ago he put in about $30,000, and then as the share price went down, he tried dollar cost averaging down by putting in another $30,000, but it didn't work. He's down 33% or about $20,000. Why did he lose money on Corsair Gaming? Now, of all these positions, Corsair is actually the most attractive to buy right now. It does make a profit. Its P/E is 17 and its forward PE is 13. But once again, insider selling as lockup agreements expire. This was a recent IPO. This puts selling pressure on it. Price to sales is only 1, guys. It actually looks very appealing to buy right now at $23. But this was not a stock worth buying when it was at $40 or $50. Of course, because this is a new company, they're going to dilute you by issuing new shares. There were 84 million shares when it IPO'd. That's gone up to 93 million, so you lost 15% on share dilution alone. But what's killed Corsair Gaming this year was that their revenue has been declining. So in 2019, they did $284 million in sales. They increased that through December of 2020 to $556 million. As soon as this number dropped, as soon as it went down to 529, this is the kiss of death for a growth stock, guys. As soon as you see revenue declining, it's no longer a growth story. And of course, people are going to sell it. Kind of obvious that during the pandemic and the lockdown, lots of people were maybe buying new gaming consoles because they're spending more time at home. But as revenue declines, I don't know where it's going to stabilize. It could potentially stabilize pre-pandemic levels around $300 million. This is terrible for their multipliers as once again, they're issuing new shares. Additionally, with Corsair Gaming, though they might make good products, I don't see what their competitive advantage is. What is the moat of this company? They make keyboards and mice and cool gaming rigs, but anyone can do that. There's nothing, in my opinion, special about Corsair. No reason to think that this 500 million in sales they were doing was going to go to $1 billion, but that's what people were pricing in as they saw this growth going up. As soon as that growth stopped, guys, I mean, you could have cut your losses by avoiding this stock in March. The next stock that Graham lost money on is a total train wreck, and that would be Peloton. Year to date, down 70%. So why did Graham lose money on Peloton? And it looks like he bought in at the FOMO, at the hype, when the price to sales of this company was 15. This company hasn't made a profit yet. It can't make a profit on selling bikes and treadmills. So to buy in when the price to sales was 15, that was a red flag. In addition, of course, it's a newer company that recently IPO'd. They're going to dilute you. In 2017, shares outstanding were 233 million. They've basically diluted you by 30% by increasing the shares to 293 million. Operational revenue, this is the kiss of death for any growth story. Obviously, during the pandemic and the lockdown, they were able to sell a lot of exercise equipment. And ideally, this exercise equipment should be lasting you 5-10 years. I mean, if you're buying a new exercise bike every year, what are you doing to that exercise bike? So their revenue increase through March got as high as 1.2 billion. But as soon as we got their financial statements in June and we saw revenue decrease, kiss of death, guys, the stock was never going to recover. It's obviously gone down again since we got their revenue statement in September. Where is their sales going to stabilize? When is it going to stop going down? It's probably going to return to pre-pandemic levels around this 466 million mark. Additionally, what is the competitive advantage of Peloton exercise equipment? Yes, they make a nice treadmill, they make a nice exercise bike, but anyone can do that. They offer a subscription service that kind of gives a community feel to their customers, but if Apple or Microsoft decides they want to start making exercise software, is Peloton really going to be able to compete with the mega giants? The final position that Graham has lost money on is Robinhood, down 20% since its IPO, and Graham put in $252,000 into Robinhood. This is not an insignificant amount of money. This is not a YOLO play, guys. $252,000 was 3% of Graham's stock portfolio, and he's down 32% or $81,000. Wow. So why did he and lots of other people lose money on Robinhood? Well, for one, Robinhood can't make a profit. This is a brokerage firm that's been operating for 6 or 7 years, and they don't make a profit. Price to sales is currently 11, but that's after the stock has gone down. So when Graham was buying in and dollar cost averaging down, price to sales was probably closer to 30, 40, or 20. Additionally, insider lockup agreements for Robinhood have been expiring, and the original investors are cashing out. They want out of this company. Not a good sign if you're trying to get in when everybody else is basically rushing out the door. Here's an article from August 5th. Robinhood stock craters 28% as investors file to sell 97 million shares one day after Reddit-fueled surge. So what happened is that Redditors drove up Robinhood's share price to $70 a share, and all the insiders in this company said, great, we can now cash out, make our hundreds or tens of millions of dollars, and anybody buying this stock, is basically going to be the bag holder. And of course, because this is an IPO, they're going to dilute you by issuing new shares. It's just what IPOs and SPACs do. Beyond that, what is Robinhood's competitive advantage? What is their moat? Now that all the big brokerage firms like Fidelity, Vanguard, and Schwab offer zero commission trades, and other startup brokerage firms like M1 Finance and Webull who have really good apps, what is it about Robinhood that makes it stand out anymore? And what is the long-term strategy for Robinhood? And I just don't see it. It seems like everything they've done the last 5 or 6 years has been in lead up to the IPO and getting a good valuation so the original investors could cash out and make a bunch of money. But where is this company going? Where is it going to be in the next 2 or 3 years? And honestly, I wouldn't be surprised if management at Robinhood just wants to be bought out. I wouldn't be surprised at all if in 2 or 3 years, as their stock continues to fall, that either Morgan Stanley, Goldman Sachs, or Charles Schwab just buys them out for their users and then basically absorbs them into their brokerage platform. So all in all, it looks like Graham put in a total position of $459,000 into these 6 positions, and that's not an insignificant amount of money. That's 5.4% of his entire Schwab account. He's stated that a majority of his funds are in index funds, So about another 40% are his other individual stock picks. I know he owns Tesla, I know he owns Google, he's mentioned some other stocks, but I don't know, 5.4% on these speculative 6 companies for a $177,000 loss. That's a lot of Starbucks coffee you could have bought for $177,000. Either way, guys, I'm incredibly appreciative that Graham is sharing his losses. This is a cautionary tale of what can happen when you have FOMO, when you buy into hype, when you don't evaluate the true fundamentals or prospects of a company, and you just end up buying something because everyone else is buying it. And many of these losses have something in common, and many of these positions were recent IPOs. On my channel, I don't recommend you ever buy a SPAC or an IPO. If it's a great company, you like the company, wait 1 or 2 years. The reason why is the company is not profitable yet. They're going to be issuing new shares, so they're massively diluting your ownership. And insider lockup agreements expire, and insiders cash out at your expense. So to illustrate the point, let's just talk about the 10 biggest IPOs of 2020. This is an article from Morningstar. I'll link it down below. But let's just go through all 10 of these stocks year to date. Have any of them outperformed the S&P 500? So here is SPY up 22%. So we'll just say 23% with dividends reinvested. So there's an opportunity cost for your money. You could have just bought S&P 500 index funds, and if instead at the beginning of the year you purchased one of these recent IPOs, how would you have done? First company is Warner Music Group, IPO June 3rd, 2020, and this stock is only up 13%. So it didn't outperform the market. It did not beat the S&P 500 index fund that you could have purchased. Li Auto IPO'd July 30th. They're currently down 12%. Let's go to the next one. Rocket Companies, they IPO'd on August 6th. Year to date, they're down 21%. What's the next one? Xpeng IPO'd August 27th. This is a Chinese EV maker. They're basically flat on the year, so they're not down at the moment. Next one is Snowflake. This is actually a pretty good company. Currently, its year to date, it actually is up 24%, but if you just zoom out another month and look at its 1 year, it is down 11%. Unity Software IPO'd September 18th. This is only up basically 2%, so not beating the index fund. GoodRx Holdings, GDRX, currently down 8%. Next stock is Palantir, IPO'd September 30th, and oh my gosh, finance YouTubers will not stop talking about Palantir. Year to date, it is down 18%. So if you had bought in last January, there was an opportunity cost. You could have bought S&P 500 index funds and made 23% on your money. Instead, if you had bought Palantir, listening to the FOMO and the hype, you would have lost 41%, net 41% on your money. Next company is DoorDash. Hasn't quite been a year yet. They IPO'd on December 9th, so watch out for those 12-month lockup agreements expiring on insider selling. DoorDash only up 13%, so it's a positive year. It is actually falling dramatically at the moment, but a positive year, but didn't beat the index fund. Finally, we have Airbnb. Once again, IPO December 10th. Hasn't quite been a year yet, and they are up 19%, but didn't beat the index fund, and the stock is currently falling hard. For fun, we can toss in one more stock, and that would be Tattooed Chef. This company did not IPO. It's a SPAC, but year to date, it is down 35%. So the lesson to learn here is that when a company goes IPO, there's a huge buzz. And when the stock has gone up 162% in 3 months, finance YouTubers are going to talk about it. They're going to say, this is a hot stock, going to the moon, buy now, it's going to keep going up forever. However, when that stock starts to turn and starts to crash and it's down 53%, they don't want to talk about it anymore. Ideally, if this is a good company that you still believe in, the stock price just got cheaper. You should be buying more. You should be committing to it, but finance YouTubers don't do that because that doesn't get clicks. So to sum all this up, I just want to thank Graham one more time for being open with his losses. I feel like this was a teachable moment about SPACs and IPOs and the risk you associate. Just think about it, guys. The 10 biggest IPOs of 2020, not a single one of them outperformed the S&P 500 index fund year to date. That's just incredible. Okay guys, if you like this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.